Hello, this is Coach Mike from winningstockcoach.com. Going to get started with my weekly market overview for the trading week ahead, the trading week beginning August 31st, 2015. If you happen to catch last week's video, how do I put this into words? Although I didn't expect as big of a drop last Monday morning, I expected that drop throughout the week. We ended the video with a little bit of an encouragement to people not to get scared out of their longs right away, but to sell on the up move. So Monday came, and it was scary. Scary for a lot of people. We hit, we bounced. We did a little consolidation, and towards the end of the week broke out of that consolidation. And the way we were left Friday was kind of almost looking like it was going to roll over a little bit more to the downside. Now, on the chart I have here displayed, you're going to see some stuff we talked about on last week's video. And, one thing I told members of the Coaches Roster newsletter, we talked about this day in and day out in the chat room this past week, was the time period that has been consistent throughout each one of these periods that we discussed last week and that myself and my members have been talking about for months. Now, I'm going to zoom this in just a little bit so we see things just a little bit better. And I want to go back to the time period here on the S&P chart where we really started to get the big drastic drops, the very clear annotation of a fall or crash, if you will. We entered last week saying we still haven't hit that real correction zone yet. Well, we did. We did on Monday. And now it's, what do we wait for? What are we looking for before we really get all hairy and thinking it's going to crash? And that's what I want to talk about a little bit here. I want you to look at the time periods of consolidation. There. This area here, which was really hairy, the 2008 crash, the drop, the month and a half before a lower low, only to come up and make a higher high from the first high that was made after the drop, but to not exceed that 50% retracement we talked about before the crash. That time period wasn't a week, it wasn't a day, it wasn't a couple hours. Each one of these candles signifies a whole trading week. And though I'm not going to be one that says that just because both of those and the correction time in 2011 were both at about 18 weeks or all three at about 18 weeks long, I'm not going to say that that's where we're at right now. What I am going to say, however, is I would be really, really cautious of my trades dictating a thesis of a crash during a time where I think the lows from last week and the highs from this past week will both be revisited several times over the next several weeks. And I think there's a very, very easy place we can annotate on our charts for where it's very, very likely for that crash to take place. Now, how are we going to do that? Our webinar in our chat room on Tuesday night specifically went over this with the members to really prepare them for a specific number on the S&P chart. And how we're going to do it in this video is we're going to compile the datas and time frames from this chart, the target points from this chart, which, mind you, we've still come within a 0.5% now on 68 market highs and lows in a row, with video data to prove that. With this chart here, And with this chart, you remember this chart was last week, I said, after that failure of that swing low there, my anticipation is we get down into this swing low, but we'll bounce from there to get us into that setup period that we're talking about right now. So let's look at these things all together. Again, here we've got very consistent time periods of consolidation in 3 previous similar times to what we're seeing right now. That time frame is going to be very, very important. The next thing we've got is a targeting system that, again, has allowed us to come within 0.5% of market highs and lows for quite some time now. Now, by inputting a high point based on the points that have been followed thus far, I actually have a little bit of belief that even though I'm finally getting around to making this video after the futures have already opened and after I see that the futures are actually down already, I believe the last time I checked the S&P futures were down around 20 points, that there could still be a little high side up into this 2020-83 target point. But what I'm really, really cautious of is that our high here was within 0.5% of that already. But again, just using a couple points, trying to establish points that we could expect to see consolidation between, that 1838.91, 2020.83, I think that is the range that we're going to be stuck trading between for a while. But I do want to get to one other quick point, is where all of that plan based on the prior behaviors of the chart will be thrown away. And that's what we're going to get to in this video. Now over here, these channels I've talked about actually had some association with the different stimulus phases. As you can see, these two I colored pink last week, we talked about, it could be one or the other in that QE2 phase. And after getting that failure here and kind of just dipping a little bit below this one, I think we could actually find a little bit of time in which we consolidate between the two, support and resistance per se. And then here with our swing points, the bounce that we had off the point we talked about last week's video, and this retest of the swing low here, even though I wouldn't be too scared if I saw it come and retest this area here, which would still be a lower high. I think that we can clearly see a zone that we could anticipate trading to be between when we mark our charts as such. But if we also look at those downside target areas, this low point that we hit the past week, when it comes to channels, I've been one that always believed that when you get one of these little subtle failures that looks like, oh, it kind of bounced there, and people start trading long for that, it's actually kind of like a little secret sign, I guess, to say, hey, be careful, because that's me pointing out to you that I am going to fail that channel. This low point here, this 1838.91, and as I look at all those things, there's one particular thing I want to point out and say. I actually had everybody in the chat room make a big sign and put it on their desks that says SPX 1800. Right here. SPX 1800. You could draw a big old thick line on your chart. SPX 1800. As you can see, with the failure of the 1800, we're not going to have much on the way of support points down here, and we're going to be more than 0.5% below our fib target point that's been very, very accurate over the past couple years. And you see the other fib target, the one that's based off the high point before the last market crash. When we go over here, we see that 1800 would be a clear failure of this other channel that we just barely dipped below at the start of last week. And here on our swing point chart, again, the 1800 level gets us into an area where there's not much to expect, but at least a retest of the highs that were made before the last market crash. Now, in an easy way, and I know last week's video was really, really long, and there is just so much data hammering us in the face right now that it can be a little bit hard to process on a reaction for the trading. So I want to try to make it as easy as possible here. In our chat room, I often talk about ways to trade certain specific points. We even talk about things called no trade zones. We're going to put a no trade zone in that very small area between 2000 and 2050 on the SPX. Now that might change if it gets up into that point and we start to see how it reacts and how the chart forms up at that point. So we're going to start with a no trade zone between 2000 and 2050 in this approach for our upcoming week. We're going to trade a very, very simple strategy in the area between last week's lows and 2000. A very, very simple strategy that actually carried us through most of the summer in a very profitable way. We're going to make that what we call our strangle and straddle zone. This is going to be the zone where no matter what we see, no matter what we hear in the media or anywhere else, we're not going to allow ourselves to become biased and form an opinion on market direction. We're going to use options trading with specific strangle and straddle type trades. If you don't know what they are, you can email me, coach@winningstockcoach.com, Google it, whatever you'd like to do. And we're going to use that area to enter strangles and straddles on the stocks that we are following when they are at support or resistance points. Very, very simple. Below last week's low, 1867 to 1800, we're going to have another no trade zone. Now, it doesn't mean that we'll sell all of our trades if we get into the no trade zones, both the high side or the low side. It simply means we won't enter more trades. Our strangle and straddle zone is going to produce times where we're kind of even in calls and puts, and those break periods into those no trade zones will become times where we are heavier on the calls between 2000 and 2050 and heavier on the puts between 1867 and 1800. And we're going to keep that in our mind, that SPX 1800 means you don't need your long positions anymore. Much like we discussed in our webinar just a few weeks ago, those of you members of the coaches roster, you'll remember the blue box on our daily chart. And the strategy we use to trade that is the strategy we're going to move forward with in this upcoming week. It's a very, very simple strategy. It's a very, very easy strategy to profit on. And it's made even easier with our time together during the market hours live in the trading room. This is Coach Mike from winningstockcoach.com, encouraging you to have a plan for your trade, to understand the approach you'll take on your trading, and to join us at the coaches roster and come trade with us. Good luck to you in the upcoming trading week, and God bless.